We'll try to get started here. Hi. Hello. Hi. Hi, my name's Michael Cayley. I'm the founder of a company called Seedling Capital Services, Inc. We apply prediction markets and social, network, and financial analysis to help investors make better decisions and build trust between investors, mentors, and startups. I'm also the director of Startup Grind. Startup Grind is a blog and meetup network that is evolving out of Silicon Valley. It was founded by a guy named Derek Anderson. Russell Kalaus is also part of the team there. We have like 15 chapters and growing globally, with chapters in Singapore. There's one in New York City. There's 3 up and down the valley. There's one in Austin, Texas, LA. And so, the reason why, there's also one in Ottawa. The reason why we wanted to develop a Startup Grind chapter is because, we're reporting, and this event is being blogged, live blogged, and webcast on Startup Grind. The primary readership for Startup Grind is in the United States. So this is a great new channel for us to be able to directly speak to our primary audience, both in terms of investors and potential customers. It's also helpful because it helps us attract investors like Howard Morgan. There's been a series of events that we've organized since May 30th. The objective of these events has been to try to shine the light on the contrast between what's happening with early stage venture and angel investing in Ontario and what's happening in the United States and other markets. So it's a shifting context around seed and early stage financing that we've really been trying to shed a light on. So that started with an event on May 30th where we in this room, we had a 8-foot larger-than-life projection of Eric Mijikowski, who is the founder of Pebble Watch. Here's a case where Eric is a bit of a protege of the educational system in Canada. He went to grade school in Vancouver, picked University of Waterloo, which has a great reputation. Because he was there, which is primarily a public investment, he was able to take part in a partnership with the Galt Industrial Design School, one of the best in the world, did that. That's where he was conceived the watch, the idea of a smart watch that syncs with a smartphone. He then developed to a BlackBerry smartphone, our domestic tech champion. My sense is that he didn't have a great, a lot of development support, but he did have some folks at BlackBerry that were interested in what he was doing. He developed 1,200 watches. He sold 1,200 watches, and at that stage, was eager to get some sort of early stage risk and capital in this country. Was unable to do it. Was accepted to Y Combinator, which is one of the best accelerator programs in the world. Went down to the San Francisco Bay Area, and through that program, he was advised to do Kickstarter. He set a goal of $100,000, and over 40 days, he raised $10.2 million. And I guess you're familiar with that story by now. So that's the emergence of crowdfunding. So we had the Jobs Act take place at the same time. On June 27th, we had Paul Connor, who's the president of the Ontario Network of Angel Organizations. He talked about the state of angel venture capital, angel capital in Ontario. One of the good news items out of there is that we recently did a deal out of Ontario where there was it was syndicated to 27 different angels. And angels have really stepped up in the Canadian context, in fact, funding more than venture capitalists over the last year or so. On the 16th of July, we had Sherwin Neese, who was one of the co-founders of Startup Exemption, a co-author of the framework that was adopted into law in the Jobs Act and led to the legalization of crowdfunding in the United States. We had 180 people sign up over the course of 2 events. We briefed the province and the Ontario Securities Exchange Commission, so we'll talk a little bit about that today as well. On just this past Monday, we had Dr. Olaf Sorensen in from Yale University. Currently, the federal government has allocated $400 million in the last budget to try to reboot risk capital in this country. And so there's been an open consultation right now. So we gathered together 14 people, British Columbia, Ottawa, Montreal, United States, for a conversation about how that capital might be deployed. We're expecting a piece in the National Post on that, and we're submitting directly to the consultation that's being led by Sam Dubach and others. And now we're going to talk to a bona fide, real-world, early-stage investor, which is it's a kind of a rare encounter of the third kind here in Ontario, because Howard actually does pre-revenue deals and does early revenue deals, investment people and plans, and a little bit of technology, and as well as other later stage deals as well. And so we hope that we'll bring a contrast to some of the kinds of experiences our startups typically have here as well. So Howard is a partner in First Round Capital. They just closed recently another $135 million fund. We'll talk a little bit later about the stage of the cycle that they're in that fund. But in 2011, he was ranked as number 12 in the top 30 most trusted venture capitalists in the world. He started his career as an academic. He's been an investor for over 20 years. A angel investor first and a venture capitalist. He's kind of one foot in both of those areas right now. He has been a very I think he was president of New York Angels at one time. Very active in the emergence of New York City's tech investing scene. First Round is based out of Philadelphia, but they have offices in Silicon Valley, New York City, and Philadelphia, those three locations. So please welcome Howard Moses. So the purpose of Startup Grind is to inspire, to educate, and to connect. And we also like to give opportunities for startups to kind of pose questions directly. So I've been all through the room tonight queuing up people. So who's ready to go and to talk about your startup a little bit? You want to stand up, talk about your startup right there, and ask a question. Yeah, go ahead. Sure.
Well, so I'm at a very early stage of my startup. Just a little bit about my background, actually. I'm from the mechanical engineering world. I'm very interested in the sustainable technology side of things. Being a Waterloo grad, I've just been really fascinated by web technology and the number of web startups that have come about. A lot of my friends are actually very successful entrepreneurs. It seems like all the successful entrepreneurs that start off in Waterloo end up in Silicon Valley. So maybe we need to talk about that a little bit. But essentially, I have a very simple idea. I'm very passionate about it, and I think it's very applicable to the marketplace today. It's called opportunity. And think of opportunity as reverse Kijiji. So as opposed to you going out there and looking for a travel agent, 5 different travel agents to book your vacation to go to Cuba, well, why don't the travel agents come to you instead? So you say, hey, here's my budget. This is what I'm looking to do. This is my time frame. And who can give me the best deal? And this concept can actually apply to a lot of different things. So let's say you're looking for a DJ for your sister's wedding, and you don't know who to contact, and so chances are there's somebody in that community, in that local economy, that is exactly looking for the opportunity to deliver what you have, with the kind of service that you need. So that's what opportunity is. It's essentially a platform where users can go on and post all their needs, and respectively, people in the local economy can can view those needs that are required and essentially respond to them and say, hey, I can do this for you for $50 or something
Do
else.
you have a question? Like,
So
what's the biggest problem you're
okay,
facing?
so with that being said,
Yeah.
well, the biggest problem, well, first of all, is like challenge biggest challenge that we face in Canada, anyways, is being able to secure the right funds to be able to get the right type of developers. A lot of world-class developers are in Canada and are situated in Waterloo and communities like that. But it seems like if you don't have the right kind of funding, they're either working for Apple, or they're working for Google, or they're working for Facebook, and next thing you know, they're down in Silicon Valley and probably working.
So your question is?
So my question is, well, how do you go about securing funding for?
Well, there's two issues. One is securing those people, right? And your model, Opportunity, which is very similar to what we do with TaskRabbit, one of our successful companies in the U.S., or even with Craigslist or with Elance. You should be able to put out the specs that you want, go to Elance, Opportunity, their version of Opportunity, if you will, and say, I need this code written. Who's going to bid on it for me?
Right.
And one of my former graduate students, a fellow named Mike Zispin, who ended up after some period of time out of Wharton as a president of Lotus and then a part of IBM, when he retired about 3 years ago, he came to Josh Koppelman, my co-founder at First Round, and I, and said he was working in the golf area. He loved to take golf trips with his friends. He had a particular algorithmic problem. How do you play 6 courses in 3 days with 8 people and pair them up in all the right pairs? I'm not a golfer, so I had no direct solution. But he remembered that we had taught him in operations research that that's an integer programming problem. He went on Rent-A-Coder and said, here's the problem. Will somebody build me an algorithm? I'll pay up to $500.
Right.
The next morning, he had 3 people send him algorithms, one from Sofia, Bulgaria, one from Czechoslovakia, and one from China. And he took the one from Bulgaria, and he's built with under $10,000 a company, Golf Trip Genius, which is now going to do about $1 million in business this year. So I think the answer is, for what you want, bootstrapping and getting, you don't need to raise the money first. You need to build a proof of concept first, then you can raise money from the venture or angel world. And in today's world, you can do that very inexpensively using the existing versions of Opportunity, which are Elance, TaskRabbit, Craigslist type of things.
Can I actually ask a follow-up question to that? Time and again, one of the things I've heard is that before you actually go out and get your product into the market, especially with ideas that have strong branding associated with them, one of the key things from a lot of ventures, capitalists and investors that I've heard is focus on your product, right? Your product has to be key. Your product has to be strong. And prior to you going out there and actually seeking funding or whatever, you get your product strong. And that's the challenge right now, is how do you get a strong product with a developer from Bulgaria, because like chances are they're going to have bugs in their code, and when you're trying to scale that product into a
look, I think the answer is if you have a developer in Bulgaria, you don't let them do the user interface design. You have somebody else do the user interface design so that the English, and in Canada, French and English, if you need both, are done properly, but all the back end and hard work is done over there. And if the code has bugs, you don't pay. So, I mean, in some sense. That's not your problem. The problem is getting something that you can have real users show you what the problems are with the actual concept. And for that, you need to have a prototype built. We're a big believer in quick, inexpensive prototyping and funding. Yeah.
Thanks.
I have a question for you, actually.
Okay. Go ahead. Yeah.
I'm president of Self-Gravity. Self-Gravity is a development company, and it would be sort of like technology incubator. So we have started a services company 2 years ago, and built all kinds of software, Ruby on Rails. We have developers, mostly propeller heads, so basically. Do services work? We still do services work. We started doing something interesting. It's starting to get the momentum. I wanted to hear your opinion on it. So rather than getting paid for the projects, for very interesting projects, we started saying, okay, we'll do at cost, and we'll take the cut or sweat equity in that. Yeah. And how does one raise the money for those types of incubators? And second thing is, now I have 3 products. they're matched. Like for one, I'm looking for co-founder with MBA. It's basically has clients, it's built, it's working, has paying clients, like and it's ready to roll out. So I need just the operational, like financing and stuff. So how does one take that from incubator and kind of let it go, let it ride?
Well, I think that's where if you have the MBA person there preparing the pitch for an angel network, there are a bunch of angel networks up here in Canada, and showing it to them to get that next level of funding and saying, here's a product, here is a customer base, it's not pre-revenue, there's actually even some revenues.
Right. Now
Now we need to scale it. Those are the type of companies that usually the angel networks really love.
Okay. And just quick follow-up questions. Is it better to get the MBA and go to angels and say, okay, here's the co-founder, here's the guy I picked, or basically go there and says, okay, here's the business. Here's the blueprint.
Better to have the MBA. Better to have somebody who's dedicated to the company pitching it, and who's both the business side, because you already have the technical side.
Good. And is there any company that finances incubators or any angel that would?
Check out AngelList.
Okay.
Yeah.
So I just wanted to note that Brian Jackson is live blogging this for IT Business Canada, and there's a webcast going on right now. So there'll be some questions coming in from the web as well. And we have Patricia, who is with Playthink, who is live sketching some of the conversation that's happening as well.
And the Twitter handle is
the Twitter handle is Startup Grind. That's right.
hashtag.
Hashtag. And there's also, I guess, at CSITO, at Brian Jackson, at Pat Kambish, at
HL Morgan.
HL Morgan, and at Seedling 8 headquarters, and at whatever. Anyhow, so let's start with the inspiring bit. So tell us a few. What's right there? What's happening? What is the? I know you did Waywire about 2 weeks ago. Maybe you can talk a little bit about that, but also Fab. Just talk about sort of what are the latest, greatest things going on.
Well, I love startups. I mean, I love working with startups, and we announced the first investment in First Round Capital 4, FRC 4, July 2nd, and that was a company called Waywire.com. And Waywire was pitched to us by an interesting group. The CEO, Nathan Richardson, had been at Yahoo Finance and had built Guilt-Man, but was always more of a media person. And the chief marketing officer, Sarah Ross, had worked at Hollywood and done PR. But the impetus for the company and the chairman is Cory Booker. Cory Booker is the mayor of Newark, New Jersey, who has been in the press a lot. He's the hero mayor who ran in and saved some people from a fire. He gave one of the most inspiring commencement addresses this year at Stanford University, which is online and you can see. And what Cory came in and pitched was a website and a social network focused on having millennials, people born between 1980 and 2005, pretty much, but the first wave of that, millennials be able to get together and talk about issues of interest to them, both social issues, how they can have impact on the world, but also issues that impact their lives, finances, the jobs, the recession, and so on, and do it with video. So at Waywire, we're producing a daily video of topics of interest, kind of a news show. Somebody called it Current TV Done Right. And then people comment by uploading their own 30 to 90 second videos of their comments on it, and you get a dialogue going about social issues. So it's going to actually launch, just beta started this week. It'll launch in early September, hopefully in time for the political season, although in the U.S. that doesn't seem to stop ever, but for the heat of the presidential campaign and a lot of the local campaigns. And it's very exciting because we have both a personality who's passionate about getting young people and public involved both in public service but in public issues and helping communities, and an audience that is an advertiser's dream, so a marketer's dream, because it's all the people forming brand attachments, so all the brand people want it. So that's a very exciting one. Last week, in the last, over the course of that 5 days, 5 companies that I'm point on raised $153 million in follow-on financing, led by Fab.com, which raised $106 million. And raising 106 million is not an easy thing to do. Even more so when the company started shipping its first product on June 9th of 2011. That's basically 13 months ago. And did $50 million in sales in the first year. Just a complete rocket ship. And Fab was started, and when we invested, and we do invest very early, it started with a concept of a social network for gay males, who are a great audience for selling travel information and so on. And when we looked at that, I was the lead, and Josh, my partner, and I, we were a little nervous because it had, that's an area that you worry about your limited partners. And First Round Capital has such limited partners as Princeton and Yale and people like that. So you say, are they going to be uncomfortable about us investing in a social network for gay people? Well, the Washington Post company decided to invest as well. So then we had some air cover, and we could get away with it. And it went okay, but not great. And one of the key reasons that our first filter in any investing decision is the people was that the CEO, Jason Goldberg, had been, this is his third company, been successful in two others. And we figured he'd get something right. And after about 7 months of the Gay Social Network, it had gotten 150,000 members, which was great, but it wasn't the million members that he thought he was going to get. And he and his co-founder, Bradford Schellheimer, who came from Design Within Reach, DWR, and Dwell Magazine, and Conran's, they sat down and they said, this isn't working. We've done some daily deals on our site that have done well. In fact, so well that straight people started trying to join the site so that they could get into the daily deals. Why don't we do something that will delight people with your design aesthetic? So we'll sell products that really look great. And if any of you have been on Fab.com, the products are all chosen as the things you might find at the Museum of Modern Art shop, or very, very high style. And spent 3 months figuring out how to market on Facebook, how to get users, how to get members. Got 180,000 members before we actually launched the first product through Design Inspiration. Now we're at 5 million members worldwide, with operations in Germany and England as well as in the US. So it's been a rocket ship. So we raised our first money at $7 million valuation. Then we raised some more money at a $30 million valuation. And that was supposed to last us through the late last year and early into middle 2012. But in January we raised some more money at $110 million valuation. Wow. And that was going to last us until we got profitable. But the growth was so enormous that we had people knocking on our door with enormous valuations. But to show you how Jason's mind thinks, we had an offer for this 100 million at 700 million pre. And when the Facebook IPO came out and did what it did, which was sputter a bit, shall we say, after the IPO, Jason went back to the investor and said, I know you're willing to pay 700 million, but it just doesn't feel right in this environment. We're going to make it 600 million. So we took 15% off the valuation, and just purely unilaterally, it hurt us because we got diluted a little more, but not very much. And so that's been great. And that's a classic pivot story. A company starts off moving in one direction, it's not working right, and the CEO, who's really understands that and is willing to admit that the single-mindedness isn't quite right, and move it to something else, can be very successful after a pivot.
Interesting part of that story is the first money was raised at a 7.5, did you say? $7 million valuation.
Yep.
And what were the ingredients to the $7 million valuation?
The ingredients were a good mock-up of what the social network would look like.
A mock-up.
More than a mock-up, yeah. a working prototype. Working prototype. A team which had a good experience, which included, by the way, a technical team, contractors, although we've since bought them, all in India, in Pune, India, which Jason had worked with for his last two companies. So the entire technology team for Fab is in Pune, India.
Nice.
But every morning at 7:30 a.m. Eastern Time, there's a half an hour Skype between the tech team and between Pune and Manhattan, and now between Pune, Manhattan, and Berlin, in fact. And the priorities are set for the day, and stuff gets handed off, and so on. So those were the key ingredients, and market study that said that the gay male audience overspent in travel, restaurants, clothing, and a couple of areas that marketers would pay for. So it'd be high advertising rates.
So you've been doing this for a little while?
A little while. So I'll give you some background,
Yeah.
I guess. So I got a PhD in operations research, computer science in 1968. I was very lucky. In 1965, I was graduating from the City College in New York, and I was going to get a PhD in physics. I got admitted to MIT, and I was at the computer center at City, which was pretty nascent then, punch cards, and I was talking to an advisor, a mentor, a fellow named Dick Hamming. Those of you engineers have heard of Hamming codes. He's the guy who created them. And he said, physics, he said, why do you want to go into physics? He said, you know, there's 1,000 people in physics. Yeah, that your chances of getting a Nobel Prize are like 1 in a million. And, you know, don't you like these computer things? He says, that's the future. He said, computers. You know, it's kind of like plastics in the graduate. It's computers. And for whatever reason, I listened to him. And so I got into computers, into computer science, really, and operations research back in 65. Graduated in 68, taught at Cornell and then at Caltech. And in 1972, went to the University of Pennsylvania, where I was tenured both in the computer science department and engineering, and I was an expert in databases, and in the management department at the Wharton School, and brought machine number 50 on the ARPANET. So, you know, this internet thing, you know, I've got 40 years of email. And some of it is still stacked up. I actually was one of the recipients of the first spam ever sent. It was sent by an engineer at the Digital Equipment Corporation to try to hire people, and since it was government funded, they said that was unsolicited commercial email and was banned, and that was the very first spam. Today I get 10,000 spam emails a day that are filtered out by the Sophos mail filter, because my emails are wide open. I'm Howard at firstround.com. It's very simple.
Right.
We don't hide it, and so as a result, all the bots in the world know it as well and send stuff in. So I did that for about 10, I got to Penn in 72. In 1982, or 1978, I started a company with another fellow at Rand Corporation called Interactive Systems. And that was the first Unix company, the first company to commercially license Unix from Bell Labs. Mm-hmm. And it was funded by a mathematician turned commodities trader named Jim Simons. Jim is absolutely brilliant guy, and he wanted me to stay and work with that company. It was my sabbatical year, and the co-founder was a guy I really didn't want to stay and work with for another year. So I went back, took my sabbatical by teaching at the Harvard Business School. But about a year later, Jim called and said, gee, I'd really like you to try to run some money in the tech space for me. And by 1980, late 81, early 82, he had worn me down, and I took a 2-year leave of absence and we started a company called Renaissance Technologies in New York. Half quantitative trading, which Jim was doing, half venture capital, which I was running. And we sort of did some overlap. I helped a little bit on that side, and he helped on the venture side. And we did a bunch of ventures. So I was a traditional venture capitalist with a $30 million fund in 1982. So I've been doing it for 30 years. And did it till 89. At the end of 89, Jim and I sat down, and he said, look, this is a top-tier venture fund. We have annualized returns of 23% compounded. It's a great venture fund. However, my quantitative trading is returning 38% compounded, and I can cash it in every morning. If I want to go home, I can take all the cash out. And on the venture side, you got to sell the companies, and it takes 5 years or 10 years. So I don't really want to do the next fund. And so I went off and did what today is called angel investing or super angel investing throughout the 90s, and had some luck with it. In 92, I invested in Josh Koppelman's first company called Infonautics. The product was called Homework Helper, became ProQuest, which is in about 50,000 schools in the US and Canada. It licensed all the content. It was sort of pre-web search. You could search all of the magazines, newspapers, etc. And then when the web came, we put it onto the web and took it public, sold it. Josh decided he wanted in 98 to do something called Half.com. Amazon had started, it was doing well. He said, what if we could sell used books at half the price that Amazon sells new ones for? And so he bought a whole bunch of URLs, half off Amazon, half off eBay, half off, the Abe's books and whatever, and then half.com. And we launched half.com, and eBay bought it for a couple $100 million in the bubble. It's actually the basis for Buy It Now, so eBay actually thinks it was one of their better acquisitions. They made some great acquisitions. Half was one, PayPal was another. And so Josh did that for a couple of years, and then in '03, he didn't want to move to California. So he came and said, let's do some investing. And I said, well, join the New York Angels. David Rose and I had started the New York Angels in 2002 out of the ashes of something called the New York New Media Association. Done a bunch of investments there, and Josh started investing, and he said, I like this. I'd like to do a venture fund. And I said, great, I'll give you half time. Why don't? So the first year of first round capital, which was 2005, we had only 2 full-time equivalents, half of Josh and half of me. And that worked out pretty well. We added Chris Fralick later on that year, and then another partner, and then we found that in '05, Josh and I made 28 trips to California. I made 26, he made 22. He had 2 young kids. My kids were already out of the house by then. It was a little difficult, so we decided that we ought to open an office in the Bay Area. And we did. But we were still based mainly out of the Philadelphia office, and I had an office in New York, which I've had ever since Renaissance, because Jim was kind enough to keep giving me space. I also had an office because in '96, and this kind of relates, a whole bunch of companies that I was on came public. I had some money, and I met this interesting fellow that I knew, Bill Gross, and Bill said, I've got this wonderful idea for a company to start companies, and it was kind of the first real incubator called Idealab. And so I was the lead investor in Idealab. Bill said, I've got some people who want to invest. Steven Spielberg, interesting people, Michael Douglas, Ben Rosen, who was a legendary venture investor, but I need a lead. So I was the lead. And Idealab is still going strong. I was on a board call this morning. It's created over 100 companies, successful companies. It's created about 500 projects. And a project is something where we'll put in $10,000 or $20,000, and if it really works, then we'll create a company. And including such things as Overture. The bill actually has the patent on paid search. Google ended up buying it for $600 million, but when he announced paid search at the TED conference in '98, people were booing. Why would you let people pay to change the order of things in search? Why would you let people, and there was huge fights about it. But of course, it led to Overture and then to Google, and it's worked very well. And lots of other successful companies. The first Idealab company is a company called CitySearch, which did well, also went public and did well. Then we did something called Cars Direct, which became Internet Brands. That was one of my projects. We did a company called Picasa, which we ended up selling to Google for pre-IPO stock. And thankfully, we weren't allowed to sell the stock until a year after the IPO, and so the stock tripled because after the Google IPO, sometimes the restrictions can help. So that's what I've been doing. But when I left the academic world to become a lapsed academic, the job was the same. I traded graduate students for entrepreneurs. And I traded PhD theses for products. And I traded a 10 to 20 year time horizon because I always tell the students, if you want to really be successful, you want to be the expert in some field, create the field now, and 5 years from now, people will be interested in it by the time you finish your degree, your dissertation. Now I'm sort of 3 years out, okay, and so the time horizon has shifted. But the job of finding and inspiring and nurturing great young talent is what I love, and it keeps me young. Mm-hmm. And fortunately, it's also made a lot of money.
And what about a moment during that journey where, it's not a great story, but it's a story of persistence? Like is there a story where, it looked like a bit of a fork in the road?
Well, certainly when I left Jim between '89 and sort of '94, it was very dicey because the issue is how do you do something when you have very little cash flow? So I was doing a lot of consulting. I set up a model where I would work with companies, and I would do something that sounded crazy to people, which is I'd invest $50,000, but I'd charge you $3,000 a month. So you were paying me $3,000 a month, but it was my $50,000 you were paying it from. I actually had to pay taxes on the $3,000 a month, but the $50,000 had bought stock. So it sounded a little weird to people. But it turned out to be a good discipline for everyone. First of all, it gave me a steady cash flow, and I separated my expense budgets from my investment budgets in my mind. But it was a little bit scary because would I have enough to support, which in that period of time from '89 through 2000 and actually through 1997, I had at least one, often two daughters in college, private colleges and private schools, and so there was a lot of outflow. So that was a bit scary. But other than that, I would say it was so rewarding from the intellectual and emotional point of view to see the companies succeed. And when companies didn't succeed, which is about a third of the time, you feel really horrible.
About a third of the time. So, often we're talking about the success rate of venture capitalists being 1 in 10. And you're saying about a third of the time.
Yes.
So interesting. So what do you think are the key differences?
Well, first of all, that definition of success rate varies from person to person, right? The fact is, we have a lot of companies that don't go out of business, right? They don't succeed in the sense that they're giant home runs, but we get our money back, the people have jobs, and so on. So those are not fail.
Right.
So the ones that really sort of go out of business or you've really lost a lot of money, that's in the neighborhood of a third.
Right. Okay.
The other 2/3, something in the 10 or 20% will give you giant returns.
Right.
And at first round, we designed our structure and the amount of money we raised so that we didn't need giant returns. In the U.S., and I guess in Canada too, almost all the exits of companies are merger and acquisition exits. 98% are below $150 million exits. So the few that make it all the way to being giant public companies, you can't plan on those.
Right.
And when we looked at the economics of venture capital in 2005, if you took a typical $400 million venture fund, in order to give your investors a 20+% return, you had to triple it. You had to return $1.2 billion. If you were able to own 16% of the companies when they went public, you had to create $7.2 billion of value, of market value. That's really hard. In those days, we used to say that if you were in all of the big ones at the time, even Facebook at that point was $1 billion, you still wouldn't get there.
Right.
It's very hard. But we said at $135 million and exits that range from 50 to 150 million, if we did enough investments, and in our case, our plan is sort of 60 investments per fund, we had a good shot at tripling the money.
Right.
And we've been, is Wood here? We've been fortunate. So we've had exits like Mint.com, one of the first personal finance things, at 170 million, Astrodata at 300 million. So exits where even though we didn't own 15% at exit, we owned enough to make our returns be what we needed.
You got a question?
Yeah, just sort of following up on the inspiration category. Almost every startup hits some tough times. Things are looking pretty grim.
Mm-hmm.
What do you tell your entrepreneurs, and can you share some stories about how some teams survive those tough times?
Sure. So, when I talk about what we look for, and I have some blog posts about it called the 6 Ps, and the 6 Ps are, and I won't go through all of them right now, but people, products, plans, profits are the first 4, but the next 2 are passion and persistence. And passion is important because if you're not passionate about your idea and your company, you're not going to be able to sell it either to customers or to investors or to prospective employees. So you need to be passionate. And the other P is persistence, because you will hit snags. So Video Egg launched. It started at Yale University, actually, some kids in New Haven. And we invested in Video Egg. By the way, literally a week after we invested in Video Egg, we got an email from Chad Hurley saying, I'm doing this new thing called YouTube. And Video Egg was the same thing as YouTube when it first started, right? So it was upload your videos and your other people can see them and so on. So we said we had a pass on YouTube, one of our more interesting passes. YouTube Video Egg started, and it started doing pretty well because they went to sort of an advertising model, and then the music companies came at them. And the music company said, your videos have music embedded in them, and we think we should own half your company. And you have to license us. And we'd say, well, what do you expect for licensing fees? And the numbers were just outrageous. And then we would talk about equity, and they each wanted to own half. So there are 4 major labels. They each wanted half the company. A little simple arithmetic. That didn't work. So we had to make the team had to make the decision of what to do because they had 6 or 8 months of money left. And they decided to go completely towards becoming a video advertising network and letting other people deal with the videos. And YouTube was there at that point. And we would be the place where people came to place their ads. We would show them how to place them, how to run them, have a better player, and so on. And very dark times because we had to change a lot of the people out of the company who weren't the right ones, but made it through. And then now it's has grown to a media company called Say Media, doing over $100 million a year business, act quite well. We have a lot of companies that go through that valley. Sometimes they go through the valley and completely change. We had one company called Odeo. It was going to be in podcasting, and Apple, right before they announced their product, Apple announced some free podcasting software, and the CEO of Odeo came to us and said, this isn't going to work. I see this, it's not going to work, and gave the money back to all the investors and said, when I figure out my next thing, I'll come to you. And he did, and his next thing was called Twitter. And however, when he came to us with Twitter, our model was to invest in things under 10 million valuation, and he wanted a 20 million valuation. So we said no. But he was persistent in the sense that he knew when that idea didn't work, find another idea. And that valley happens a lot.
He'd raised 20 for Odeo, right, to begin with?
He had raised about 20 for Odeo,
right.
Gave it all back.
Right.
Gave it all back. He had some money because he had sold Blogger to Google before that.
Right.
And then did Twitter, and all of the investors except one took the check and cashed it. One of the investors didn't, actually. And then a couple of other new investors did invest when he came to them at 20 million. We didn't. That's a rule we changed when it came to Square. And we're glad we did.
Right.
Yeah.
So what do you think are the key differences between you as a selector of early stage companies, and why is it that the majority of investors probably don't play in that space and don't have the same antenna?
Well, we are a prediction market like Seedling, but we have only 6 people doing the predictions, which is the partners, right? So we're taking a look at something and we're doing our own voting scheme on it internally. And we do actually have a lot of analytical data about how we vote and what we vote on and what drives us. I think part of it is that all of the partners have been successful entrepreneurs or really early in entrepreneurial companies. So we have some sense of what entrepreneurs want and need, and we want to be able to help them through that. Secondly, we stick to our knitting. That is, we do no biotech. We do almost no hardware. Every now and then we get seduced into it and we keep telling ourselves not to do it again. We did a thing called the Pleo robot, which is a great, lovely product, but went bust. We're in a company called Ambient Devices, which came out of an MIT group, which does the weather watchers and other stuff like that. Okay, surviving but not prospering. So we stopped doing hardware. So we stick to what we know. Josh knows consumer marketing on the internet great. Chris Fralick, my partner, is one of the world's experts on advertising technology. We've got 25 different ad tech companies. When it's heavy technology, I've got my computer science background. We have one of our new exciting companies is MemSQL, MEM SQL. It was designed by some guys out of Facebook to solve the problem of updates. So everybody's going to NoSQL databases, MongoDB and so on, because when you have to do heavy updating, the traditional SQL databases do a bad job. They do 30,000 updates a second. MemSQL has demonstrated over 1.5 million updates a second now with their new technology. And it's kind of revolutionary, but it lets you use full SQL, which really a lot of big companies want to do. So that's the kind of thing that I get more involved with. And so we've learned evaluate, and we do have we bring the companies in, and we rate them on market size, people, market size, team. So that's a little different than the people. The deal terms, and we rate them on a 1 to 5 scale. And then then you have to give a 1 to 5 rating for which you do the deal. You're not allowed to vote 3. So you have to vote 1 or 2 or 4 or 5. So we've been doing this for about 4 years, and we had an intern last summer analyze all our votes to try to figure out our biases.
Mm-hmm.
And so we're trying to understand and overcome the biases. If people ask Warren Buffett why he's such a great investor, right? And he, his usual answer is, I'm rational and you're emotional. I'm looking at 5 and 10 year horizons, and you're worried about what happens in that interim period, and I just ignore it. So we kind of are trying to get to a more quantitative view of what we're doing, and remove our emotional biases, and hopefully that's part of it.
So we're going to talk a little bit about the emergence of New York City, but before we do that, is there another startup that wants to? Yeah, go ahead. You want a question? Do you have a startup?
I do have a startup.
Okay, what is it?
Just quickly, it's a way for groups of people to make a decision about attending a ticketed event and pay as a group.
Okay.
So social payments.
Okay.
So my question is, if I know I'm going to need venture capital, is there a reason I need to go to Angels first, or can I go to a venture capital directly? And if so, what's the best way to connect?
Well, you certainly can go to venture directly. You don't have to go to Angels first. Usually, if you want to get a good valuation, you want to have more proof of concept by the time you go to the venture. That's so. The Angels will usually give you. Most venture firms don't want to put in $100,000. They're not structured to do that. Our firm is structured for an average investment size of $500,000 initially. We'll follow on, but most firms don't do $100,000 or $200,000.
When you say proof of concept, do you mean technology or in the market?
In the market. When it's a consumer product, we really want to know, will the dogs eat the dog food?
Okay.
And particularly because it's so inexpensive to find that out in today's world. And by inexpensive, the Golf Trip Genius is one example, but sort of $20,000 to $50,000, you should be able to at least show some evidence that it can or can't work in some local geography. Because particularly with ticketing, and we've seen dozens of things that relate to the ticketing space and group payment space. You have events all the time that you can put up, and you go to a college campus, you go to UT or you go to Waterloo or someplace and say, are the students going to use this? Well, if it takes off in the student population, then you go to the venture capitalists and say, look, we've got this thing that seems to be working, and that's kind of Foursquare. What happened with some of those kind of companies. They did it very locally, proof of concept and venture.
Thank you.
Go ahead.
Just very quickly, my startup is a digital retail labs. We're doing a self-payment, self-checkout app. And I'm curious if your company would invest in multiple companies in the same space. So you mentioned you wanted investors in Square, so that's like what I call the interaction required mobile payments.
Yep.
And so we have like interaction-free mobile payments. So just wondering if you would...
So dealing with conflicts is a very, very difficult, particularly because we have 150 active investments. We've made over 200. It's something that we face all the time. In general, our policy is we won't invest in something that's clearly a direct competitor to an existing company. We often have, because companies pivot into competition with one another. When that happens, we make sure that there are 2 different partners on the companies and that they don't share information that the companies would not like to see shared. When you have something as broad as the payment space, there are going to be so many different solutions. So we'd be more concerned in the fact we were in Saving Star, which is mobile couponing that ties into the payments. We were in Sticky Bits, which was mobile barcode scanning of objects to get price and product information. So there's a lot of things that are likely to pivot and come up against the kind of things that you're doing, which you explained to me a little earlier, even though I think it's a good idea. So the question is one of, we don't like to do direct conflicts. We try to avoid it.
Okay, so over the last few years, point blank, which city's more important now in tech? Is it Boston or New York?
New York. In information technology, in infotech. Life sciences, Boston.
Right.
In information technology, New York.
Certainly, a few years ago, you may not have said being as comfortable as sort of coming out with New York, although you're a big pro New Yorker. But so, what are some of the keys to the emergence of New York as a really a technology stronghouse?
Well, the key to creating the entrepreneurial ecosystem that works, which New York now has been successful startups that grew and sold. So in New York, the keys of that were DoubleClick, and the great New York presence for Yahoo with Yahoo Finance and for Google with all of Google's AdSense. So Google was created, by Larry and Sergey out in Mountain View in Palo Alto, and that was all great. And then they sent this guy Tim Anderson to New York and told him to sell ads and send money. And Tim basically built an ad sales force, the AdSense technology, and the ways to send the money back. And when Google went public, there were hundreds of Google New York employees. People never really knew about them, but it was a huge ecosystem, and they made a lot of money in that public offering, so that they could then leave and be entrepreneurs. So, and they were very technically savvy because Google hired people for engineering talent. So we had Google, Yahoo, DoubleClick, and AOL all teaching people, and then they came out to be entrepreneurs. At the same time, Union Square Ventures started, First Round Capital started in New York, and about a year or two later, Alan Patrikoff, who had been a major venture capitalist, created Apex Partners, decided he didn't like this giant private equity world and started Graycroft Partners. So you now had $150 million funds that would invest in startups, in very early startups. So Union Square, which did do Twitter and Zynga and Foursquare, and Foursquare being a prime New York one, we doing a lot of stuff in New York, found that we could build good companies. The other part of it is that every one of our California companies that was advertising driven, like Say Media, ended up with more people in New York than in California because the sales side of the business became more important than the technical side. And then the third piece was 2008 and the economic collapse, which meant that all these people on Wall Street who were really happy making $600,000 a year at Morgan Stanley as a lead technical person, that job went away. So they're brilliant technologists, but there were no jobs in the financial world. They had to go do something else, and they became available to us. We actually, about a month after the crisis, started a website called Leave Wall Street, Join a Startup.com, and posted all the first round jobs on it, and generated a whole bunch of jobs and so on. That's not the exact name, but something like that. And it was true. People did start doing that, and they really did go into the startups.
Any role that government played? Any role that culture plays?
Well, government, the New York Mayor Bloomberg and the Economic Development Commission have been very good to startups. They've been encouraging the Economic Development Commission. They started some accelerator space. They invested in something called the New York City Investment Fund, NYCIF, which would actually invest city money in New York companies if they agreed to leave a certain fraction of their employees in the city. They provided space incentives down in the Lower Manhattan development area after post 9/11. They started New York City Seed, a program for a seed stage accelerator incubator program. So the government was helpful, but not at all critical. I think things were on their way, and that helped a lot. And then what's helping now, and this really only emerged 2 years ago. I think the whole thing sort of started. We started the Angels in 2002, Union Square Ventures first round in 2004, 2005, beginning of 2005. The real acceleration came, no pun intended, with the accelerators. Techstars came to New York, Dream It, New York City Seed, Entrepreneurs Roundtable. We now have probably a dozen active accelerators in New York City.
All private sector.
Two public sector. One public sector, New York City Seed. Two that are educational linked, NYU Poly incubator. Okay. So some public funding in those.
Okay.
And the rest, pretty much all private. The city is now trying to use public money to move people into the boroughs. So Brooklyn is starting to emerge, and Charlie O'Donnell, who had been an associate at First Round Capital, left and started Brooklyn Bridge Ventures and he claims he will invest in Brooklyn and the Brooklyn suburbs, including Manhattan.
Okay.
We'll see
No,
how that-
suburbs. So you've got some investments in Ontario.
Mhm. So at first round, we have been mostly agnostic in North America in terms of where to invest. We have one investment in Toronto called Influitive, which we just did. It's in the social media advertising space. We're very excited about that one. We did two investments in Calgary. One was Stumble Upon. They moved to the Bay Area.
Right.
The other was Tint, which a New York investment that I'm point on, 33 Across, acquired, but that other New York investors did. Metamorphic
Right.
Ventures did the initial version of that. And there's still a small team in Calgary, but most of that company is now in the U.S. We used a number of tech teams in Vancouver, including Gust's technical team, which is based in Vancouver.
Oh, that's right. Yeah.
And we looked at a couple of things in Montreal. And
would you do
started to
another
look-
deal in
started to-
Ontario?
Absolutely, absolutely. I mean, that's what we're looking for. It's good deals.
Any contrast between? Do you have co-investors here that you'd like to work with, or is there any contrast between the investor culture that you've encountered here and the investor culture?
Well, we started working with what was BlackBerry Fund, and it's changed names. I
Right.
forget the current name. There's a new name for it. And they invested in some of our West Coast companies, in Zobni, for example. The investor culture in the U.S. is one that the successful investor culture ignores failure. That is, you're allowed to fail and then start again. In fact, sometimes we think that we're better off the second time around because you've hopefully learned the lessons from that first failure. You don't see any of that in Europe. It's a disaster in Europe. You fail, you're pretty much ostracized. And the same has been true in much of Asia, although not so much in China. And in Canada, it's sort of in between because you're sort of still, in some ways, partly you're the Canadian culture, which is its own wonderful culture, influenced by the U.S., influenced by England, and so there's a little bit of that tension between do we reward failure or don't we?
Right.
And I think that's one of the things that investor culture changed. We don't have any specific preferred investors. We work with Innovia, which is based out of Montreal. We work with Matt Golden here, who was at RIM BlackBerry.
Right.
It has this other
Right.
one, RBC, whatever it's called now.
Yeah.
You have a question out there?
Are you flowing the money through, like investing it right into the Canadian companies, or are you flowing it through Delaware?
In Influitive, I think it's directly in the Canadian company. There are some issues, tax-related issues when you sell it. I know with Tint, there were a lot of issues on
That's
the sale.
changed, right?
Some of that's
Section 118.
Yeah, that's changed, but that it was very difficult. It's now become a lot easier. I think with Influitive, it's a direct investment, but I won't swear to it, but I think it was.
So now a little bit about the shifting context of early stage investing, technology platforms like AngelList. I mean, are you using that for deal flow? You know, we have something in that space. The emergence of crowdfunding and funding alternatives like accelerators and incubators.
We want to see all the good deals that are out there, and that means we look at everything. We do look at AngelList, although I would say we're more likely to fill out a deal that we're already thinking of doing with people on AngelList than to initially see a deal from AngelList. With the accelerator side of things, we absolutely love them. We mentor accelerators all over the country. We mentor accelerators in LA. When I was in LA in January, February, I was at 5 different accelerators that had started up there. In New York, we're part of the Techstars program. So we funded a Techstars company called Remind Me out of this year's Techstar group. We funded a company called Public Stuff out of the Entrepreneurs Roundtable ER Accelerator last year. We funded a number of things out of Techstars Boulder. We funded over the years probably 10 companies out of Y Combinator and Techstars San Francisco. We think the accelerators are terrific because they do the first filtering. We see about 3,500 deals a year now, as I was saying.
Right.
And we do.
And that's gone up by 500
That's
over
gone
last
up
year.
over, yeah, that's 500 more than last year when we saw
Right.
3,000. And we do in the neighborhood of 30. So it's kind of my real job is to say no to you politely and with some constructive hints so that when you have the next thing, you'll come to me with that as well. Because 99% of the time I'm going to say we just can't do everything we'd like to. And we have to want to make sure that we're helpful in that. No, it's not just.
So does this feel a little bit bubbly though? I mean, I remember in the late '90s incubators, accelerators. I mean, there was an explosion.
Yes.
Now, I mean, I think there are different
we
drivers now,
we saw it at Idea Lab. Obviously, we saw a lot of people in LA starting to do accelerators and incubators and so on, and way too many companies being done. Now, the difference between 1999 or 2000 and 2012, we had some amazing ideas at Idea Lab that turned into great companies in 2012 that failed for us at Idea Lab in 2000. Why? We had 10 million people on 56 kilobit modems connected when they could dial in. Today, you've got 1 billion people connected all the time on broadband and on mobile. So the available market is literally 100 times bigger than it was then. So there's a much better chance that companies can succeed now. So in that sense, it's not nearly as much of a bubble as it might be. There's a pricing bubble in the Bay Area. That is when good deals in the Bay Area have gotten very expensive. And economics is very simple, supply and demand. And there's a lot of capital in the Bay Area that doesn't like to leave the Bay Area. They like to stay there. One of our advantages starting out in Philadelphia, New York, is that we are perfectly happy to invest in Boston and Austin and Toronto and San Diego and Los Angeles and Seattle and so on. And that gives us an advantage being in geographies when the Silicon Valley guys used to say, we're never going to invest more than 30 minutes from the office. Now, to be fair, Excel now puts people in New York. They're in 4 or 5 of our New York deals, and Bessemer's in New York, and a lot of those big funds have done it, but there's still an advantage.
A question. Oh, sorry. Anything from the web or the blog? Okay. There was a question earlier from a startup that was emailed to me in advance. It's a question about foreign market penetration versus local funding. So they've ran into a problem where they've got their initial sales. It's in a foreign market, and they're not getting any domestic interest in funding the company.
It's always difficult because we're trying to work with our own instincts. So we want to be able to call up the customers or become a user of the product. And if the product is designed for the South Asian market, but built here, we find it hard to test, right? And so, in some sense, that is definitely an issue. We have a lot of that issue with Israeli companies, where they'll have the technology built in Israel for the European market, and then they'll say, oh, but we'll bring it to the U.S. eventually. We find it very hard to fund those companies. I think that is a real barrier.
Okay. One more question.
Just on that point, are you investing internationally? Like you hear some of the VC funds in the U.S. going over to China and starting funds over there. Are you looking at that as opposed to coming to Canada? Or?
No. We have looked at it. We've decided no, we are not going to invest. We're not going to start a fund in China, in India, Europe. We did 2 or 3 investments in England and a couple of Israeli companies that were mainly U.S. based. Those have actually been successful. I spent quite a bit of time in China a couple of years ago talking to venture people who wanted us to do early stage venture in China. And I went to Fudan University, and they showed me some great companies, and they said, these are our companies. We'd really love some your private investment. These are private companies. I said, oh, private company. What's the cap table? Well, 33% is owned by the PLA. That's the Army. 25% is owned by the city of Shanghai, okay, and then another 10% by the central government, but the rest is private. So who has control, right? So we've decided that China was not the right place for the type of thing we can be successful at. I think there's a lot of successful companies being created in China, but we just don't have the expertise or what it takes to do there.
So the fund is at a good point in the cycle?
We started investing 21 days ago, or 24 days ago.
And it's a $135 million fund, and how many will you do?
We'll probably do about 70 deals in the fund in total. 60 what we call on-model deals, which are $60 $500,000 investments, 20 a year.
Right.
Maybe a little bit more. And then another 10, 100, 150, $200,000 investments.
Any themes or characteristics or stages? Obviously early, but...
We're early, hopefully successful. I mean, we want to make sure everybody today has a mobile strategy, a tablet strategy, because that's how most of the customers are going to be reached over time. We love e-commerce. We think there's more. The more money is shifting from buying in physical stores to buying online. The younger generation, I'm 42 now, hex, and we see the younger generation is buying online. My daughters.
Are you pointing to me when you say younger?
Oh, absolutely.
Awesome. I'm young.
So, and buying everything online. When we started Cars Direct, the question was, would people buy cars online? And the answer turned out to be yes, they would, even though they were $50,000, $60,000. But Amazon has absolutely spoiled the consumer around the world. If you see something that you don't actually need in the next 10 minutes, you'll have it the next day from Amazon if you really need it then, or in 2 or 3 days. And that makes it hard for companies like Fab, where people want that instant gratification because we don't want to have a lot of inventory. How do we compete?
Right.
So e-commerce is definitely a continuing theme for us. We think that the use of social media and social networks as a marketing tool is going to continue to grow. Things like Waywire and lots of niche social networks which will be created, and we'll do that. And beyond that, one of the things that keeps me going every day is seeing things I completely never would have thought of that come over the transom or come from recommended by somebody. That you really got to look at this. This is a really clever idea, and I say, wow, that is really clever, and I could make a big business.
So in the graduate, the recommendation was plastics.
Yes.
And somebody said to you computers, and if somebody was standing there with Mark Zuckerberg, they probably said social networks.
Yep.
So what are you saying?
What I say
now.
What I actually say is genomics.
Genomics.
And so some of my personal money, not first round, although we have one investment there, is in bioinformatics and genomics. Because over the next 25 years, the biggest change that we're going to see is going to come from the area of genomics. Right. We are investing in personal health at first round. We just did I don't know what's announced actually, did a company that's doing sort of health concierge medicine type things.
Right.
We're doing a lot of things using big data.
Yeah.
Big data is definitely a focus, but it's not a focus because it's so horizontal.
Right.
But it's a focus in the sense that personal health and what some people are calling the the analyzed self, or the quantified self, the quantified self, where I carry a pedometer and I try to figure out how I'm doing on my weight and other things like that every day. That's huge, but the big piece of that is understanding your personal genome and what you can do to affect that. So if kids come to me and go into graduate school and they say, what is it? I joined the board of Cold Spring Harbor Laboratories, James Watson's lab, to learn more about that.
So one last point that I skipped over before. So Howard is one of 5,000 investors in the United States who signed a petition that helped get the Jobs Act over the hump in the United States. It helped get it approved. He's one of many leading investors who expressed their support of the crowdfunding movement in the United States, something that we've found quite difficult to identify here in Ontario. So what do you think about crowdfunding?
I think it's terrific. I see out of the deals that we turn down, there's a reasonable chunk that are what we call UNI, user not investor. That is, hey, that's a neat idea. I love it. I'll be a user, but it's not going to build a $100 million company. It might build a very profitable $20 million company. Those are perfect for crowdfunding, because if you can put together 100 people and raise $1 or $2 million crowdfunding, you can have giant returns for those people.
Right.
It just doesn't fit the venture fund model.
Right.
And I think that's exactly what's going to happen with the crowdfunding world. With some, obviously, stumbles along the way in terms of people making sure it's legal, honest, and all those kind of issues. We do think that if you're going to crowdfund with the hope of later getting venture capital, there are ways to do it, like using special purpose vehicles, so that I, as a VC, don't see 150 investors.
Right.
I see one, crowdfund vehicle.
Right, but it can be dealt with.
But it can be dealt with.
Yeah. Okay. Okay, one more question from Peter.
How critical is having a solid business model in an early stage investment? I mean, a lot of times, Twitter is still searching for a business model.
Yes.
So there's a difference between a good idea and then the sustainability of the business model. Do you, at first round, advise on business models with the companies, or do you give them a chance to just sort things out? Especially in healthcare, because
Well, healthcare is, in the U.S. in particular, with the Affordable Care Act, is going to be changing. The whole paying system is going to change so dramatically. Look, we want to make sure that business model is a piece of the person's thinking, of the entrepreneur's thinking. And if he or she, says, well, we'll just get a lot of users and then we'll figure it out, that doesn't really work for us. But we do know that they might not have the exact business model right at the beginning, but they have to have some thoughts about who is eventually going to pay. And one of the, I have a couple of books out on marketing with Len Lotus at the Wharton School, and we have what we call our 3x5 marketing matrix. There are 3 things that you're selling when you have a company. You're selling your product, you're selling your shares of stock, and you're selling the image of the company. And you're selling it to a bunch of constituencies, one of which are customers. Those are people who give you money. Another of which are users. Those are people who use your product. Sometimes they're the same. Often they're not. I have been a user of Yahoo since 1996. I have never been a customer of Yahoo. Never given them a nickel. So often I get the marketing plan or the business plan pitch for the user, product pitch. What I want is the investor, because they give you money, share pitch. Why should I buy your shares? What's going to make the company valuable, as opposed to simply, why is this a great product? We need to know about the product. So you need to be thinking about who you're marketing to. And the user share, the investor share pitch is the one that needs to have at least some thoughts of business model.
So at least 3 views of money that have to be in that pitch.
Yeah.
Exactly. The customer and the investor.
Yeah. And then there are 2 others, which are the employees you're going to hire. You have to sell them. You have to sell them on your shares if you're doing them options. You have to sell them on your image. It's why it's fun to work there. And then suppliers.
Okay, so in addition to, well, thank you very much, by the way, and thanks for a great bunch of questions. So about 3 weeks ago, maybe 4 weeks ago, so we booked this event probably almost a month and a half ago. About 3 or 4 weeks ago, I sent Howard an email because I watched you do This Week in DC, where you laid your stake in the ground as the inventor of office hours.
Yes, we did.
So I thought, well, perhaps we might be able to persuade you to do some office hours here in Toronto. And you agreed, and we worked with the Mars Accelerator, the Mars Commons Jolt program, and the Mentor Network, Seedling, also a part of the selection, or part of the input process, I should say. So we have a list of, Howard expanded the list to 12 companies that have an opportunity to do office hours with him tomorrow morning, starting at 8:30 a.m. Originally announced at 10, 8:30 a.m. till 11:30 a.m. We'll post these companies on our website as well. But do you want to read those lists off?
And by the way, I should say this is the second time we're doing office hours in Toronto. About 3 years ago, my partner Chris Fralick and somebody else, Christine Herron, were on their way to do some skiing and came by and did office hours. So office hours is 10 minutes. You get 10 minutes, and we can talk about anything. It can be a pitch. It can be questions about what you're doing. It doesn't have to be sort of a formal pitch kind of thing, but it's a strict 10 minutes. XYZ Interactive, Note Solution, GreenGage Mobile, Vengage, Toutit, Squag, HitSend, Engrosser, Job Deals, Gesture Technologies, Unoa, Tunesy, Pinpoint Social. I think that was probably 14.
Is it 14?
But we'll make it work somehow. That's why we're starting. And my partner's meeting starts at noon, so I really do have a hard stop to get back to my hotel by noon.
Thank you very much.
Michael, thank you.
All right. Thanks. So Startup Grind is about inspiration. So this man's in 150 deals. It's about education. We learned a lot this evening. It's also about connecting. So this part is for you. If you don't leave knowing somebody new out of this group, then the event's been a failure. So please take some time. We're going to, well, at least I am, go over to Startup Drinks, which is at Ocho, which is about a block away. you're welcome to join if you have some time, and join that event that's also going on right now. Thanks again. Oh, wait a minute. Yeah, so wait. This is a copy of Reid Hoffman's book, and I forgot to give it out, but this was one of 2 books that